Canadian inflation edged higher in December, but will it be enough to have an impact on the Bank of Canada and interest rates? Joining us now to discuss is Robert BoC, Senior Macro Strategist with TD Securities. Robert, great to have you back on the program.
Thanks, Greg. Great to be back.
Right.
Helps to have a couple days to dig oneself out after the storm.
Yeah, it took me until yesterday until I felt like physically recovered again. But, I think it was a good workout. I think I might come out the other side of it looking stronger. We got a fresh inflation report. I'm still getting used to the fact that they land on Monday mornings. What did we get in this report?
So on surface level, this is the definition of a mixed report. The market expected headline or total inflation to come in around 2.2%. Came in a little bit hotter than that at 2.4. We in the market were looking for core inflation to come in around 2.7. It came in at 2.6. So on balance, you've got stronger headline, softer core, bit of a mixed lean, but we think that there are very reasonable reasons that headline accelerated. The biggest one being that we did have this temporary tax cut introduced last December. So that introduced a very large base effect. So because prices pulled back last year, that means even without any change in December of this year, you did have an acceleration for things like food prices, bars and restaurants, children's clothing, some recreational components as well. So, that is what drove the headline acceleration here. If you look through that, the details were much more dovish. Those 3-month rates of core inflation that the Bank of Canada has focused on in the past, those are now sitting below the midpoint of the Bank of Canada's target range. They're at their lowest level since 2024. So, that speaks to, these persistent underlying inflation pressures that have been holding core inflation back over the last year or two. Those are slowly starting to fade away, and the core inflation backdrop is looking considerably tamer heading into that January BoC decision than it did 3 months ago in October.
Let's talk about that decision that is coming next week. You get the inflation print. We are so consumed with inflation for such a long period of time, and for good reason. I think, did they put out their business outlook survey today? We got retail sales later in the week. When we start getting all this information, what is the BoC thinking about the economy, thinking about interest rates?
So I think if we start on the inflation side, that stronger headline, softer core that we saw today, that paints a pretty nice metaphor for how inflation has evolved since that last forecast we got from the Bank of Canada in October. So their October monetary policy report looked for headline inflation to hold around 2% over the fourth quarter. We were at 2.2 in November. We actually accelerated to 2.4 in December. So, headline inflation has been stronger than the bank thought, but those core inflation measures that are less impacted by temporary tax changes, volatile energy prices, and what have you. Those have come in below the Bank of Canada's forecast that. They were looking for it to average around 2.9%. We're coming in a little around 2.8. And again, when you look at the 3-month rate of core inflation as kind of sort of an indication of where that momentum's trending, it's trending significantly lower than that. So, the last time that 3-month rates of core inflation were near these levels was early 2024. We really only held there for a month. So if this recent deceleration is sustained, that would kind of bring us back to levels that we haven't seen since late 2020, early 2021, before energy prices spiked with Russia's invasion into Ukraine. So inflation backdrop's looking considerably tamer. There is a little more uncertainty around near-term growth tracking. The Q4 data hasn't been quite as strong as the Bank of Canada looked for in their last forecast update. And really the labor market has been that one bright spot for Canada. But we do think that you should be taking some of that strength with a few grains of salt.
So when we take a look at all this, do we feel that this is, we can take the bank at its word? They've basically told us they're on hold and props for a nice long period of time. We get a decision next week. I get the feeling that the House view is they're not going to do much next week.
We don't expect the bank to do much. We think they are going to stay on hold for the next year. But the Bank of Canada, just acknowledged in December that, or in the December minutes, I should specify, that their next move might actually be a hike. That's something that markets have been pricing for the last couple of months, but the central bank always takes a little bit longer to put those words on paper. Given the rapid deceleration in core inflation, given that weaker trajectory for Q4 GDP tracking, some of that enthusiasm around the timing of hikes might be a little bit unwarranted. What we're seeing from the recent data is that there is still a lot of uncertainty around the near-term growth outlook, around U.S. trade, that has continued to weigh on Canadian firms and households. And it's going to take a little bit longer for the growth outlook to stabilize. So we do look for the economy to find its footing in the first quarter. We do look for Canada to start absorbing some of that excess supply that's built up over the last couple of years. But when we look at this morning's inflation data, we think the Bank of Canada can remain patient here. We think that the door isn't completely closed to rate cuts, but as they sort of look forward at the timeline for bringing policy back to neutral, because we are sitting below neutral right now, they're certainly not going to be feeling in any rush to hike rates with core inflation coming off and activity on a softer footing.
And for people who follow this as closely as we do, of course, longer term, you're thinking at some point you take away that accommodation, that would mean a hike in the key rate. I think when you talk to the average person on the street, they've been hearing the story about cuts for so long that might surprise them a little. Like, what are you talking about, a hike here?
It might be surprising. I think a lot of people, are still getting used to the fact that rates might not be heading back to where they were between the financial crisis and the pandemic. But the Bank of Canada has been discussing this, not just since rates peaked, but really throughout their last hiking cycle, that the next 5 years might not look very much like the last 5 years. So it is going to take an adjustment. That is one of the reasons that the household sector has been a source of uncertainty as well. Just all these mortgage resets, households have been very reluctant to lock in at these levels for another 5 years. That adjustment to the psychology is something that's still going on.
So we have, of course, a lot of uncertainty globally around trade relationships, ours with the Americans with the Europeans. So without the help of a crystal ball, what do we think about the Canadian economy going through this year? We got trade renegotiations or reviews coming up. I feel like it's hard to put your finger on any one thing here.
Yeah, so I think our view of the Canadian economy in 2026 is that trade and investment uncertainty is going to continue weighing on growth over the first half of the year. But we are also going to, we're not expecting large one-time shocks like we saw in last year. Those when tariffs were imposed in March and April of 2025, export orders dried up. Some of those came back, some of those didn't. But without another rapid or sharp increase in U.S. tariffs, we believe like most of that bad news is already in the rear view. As we look forward, we do expect to see a little more traction from fiscal stimulus. So the federal government introduced about $60 billion in new spending, between the 2024 or December 2024 and last year's budget. So that is going to continue generating more lift as we get into the next year. We'll also be seeing a little bit more support come through from those last rate cuts. The Bank of Canada only brought policy into accommodative territory, over the last 3-4 months. So we haven't seen the full impact of that yet either. And then, as we do get into the second half of 2026, we do expect some of that trade uncertainty to dissipate just a little bit, and that should help unlock some more investment going forward as well.